Okay, let's just jump right in. Picture this. It's December 2025, and a shock wave is ripping through the global silver market. But what we're about to break down isn't just another price spike. No, this is the story of physical reality, finally declaring war on a world of paper promises.
And right away, just look at this number. We're talking about a single ounce of silver trading in a brand new, powerful range, $61 to $64. Now, to be perfectly clear, this isn't just a new high. This absolutely shatters a record that has stood for over 40 years. And this quote right here, it gets to the heart of it. This is why this is so important. It's about so much more than a number on a screen. We are watching a fundamental break in the entire system, and we're going to show you exactly what that means.
So yeah, the price it's just mind-blowing. But the real story, the one you need to understand, is why it's all happening. The very mechanisms that are supposed to control the silver market, they're failing. They are literally crumbling under pressure, and we're seeing it happen in real time.
And just think about the speed of this move. A gain of over 115% in less than a year. Folks, this isn't just a bull market running hot. This is a complete and total paradigm shift for the metal.
Now, you might think the epicenter of this financial earthquake would be New York or London, right? Wrong. It's Shanghai. And what's being called the Shanghai signal? Well, it might be one of the clearest signs of global panic that we have ever seen in this market.
So what actually went down? Well, late on a Friday, after everyone's gone home, the Shanghai Futures Exchange, the SFFE, they made a move out of pure desperation. They suddenly jacked up the margin requirement on their silver contract to a staggering 17%. The timing, the size, this was an act of pure panic. So what even is a margin requirement? It's really important we get this. It is not a down payment. The best way to think about it is like a security deposit. It's the cash you have to put up front just to prove you can cover your losses on a bet. So when an exchange raises margins, what they're really doing is making it way more expensive to even stay in the game.
And this chart really puts it into perspective just how insane this move was. Look, a normal commodity margin is somewhere in that 5 to 10% range. To jam it all the way up to 17%, that's not just tapping the brakes. That is yanking the emergency brake with both hands because you are terrified the whole thing is about to fly off a cliff.
Let's be really clear about what they were trying to do here. By making it so unbelievably expensive to bet on silver going up, they were trying to engineer a price smash. The goal was simple: force people to sell their contracts, flood the market with paper, and slam that price right back down.
But why Shanghai? Why does a move there send such a bigger shockwave than one in New York? Well, this gets us to the absolute core of the issue, the historic battle between the paper market and the physical market.
And this really says it all. You've got the COMEX in New York. That's the paper market. You can think of it as the casino, where it's all about speculation and paper bets. But then you have the SHFE in Shanghai. That's the physical market, the factory floor. It's where real companies go to get real metal to build real things.
And believe me, that factory floor is gigantic. China is by far the world's #1 silver consumer. The metal is absolutely critical for their solar industry, their electric vehicles, their electronics, you name it. Their industrial appetite is just relentless. And for so many of these high-tech uses, there are simply no good substitutes. So when the main hub for the world's biggest physical buyers starts to panic, that is a global red alert. Hey, just a quick pause here. If you're finding this breakdown valuable, and we hope you are, do us a quick favor and hit those like, share, and subscribe buttons. It really helps us out and ensures you won't miss what's coming next. Now, here's the thing. A margin hike, as dramatic as it is just a band-aid on a gaping wound. It does absolutely nothing to fix the real underlying problem, which is a massive structural deficit in physical silver. In fact, that panic move in Shanghai, it's just proof of how severe that deficit has truly become.
And this is not just happening in the East. I want you to look at this number, 70%. That is the collapse in registered silver inventories at the COMEX in New York since just 2020. The vaults that are supposed to be backing all that paper are being drained, both in the East and the West.
And if you thought that was bad, well, this just broke. China has now announced that it's imposing export restrictions on its own silver, starting January 1st, 2026. Let that sink in for a second. The world's biggest consumer is no longer just buying up everything it can find. It's now officially moving to lock down its own supply from the rest of the world. So the obvious question is, why can't miners just dig up more to meet all this demand? Well, it's not that simple. As you can see here, over 70% of all the new silver that comes out of the ground is just a byproduct of mining for other metals: lead, zinc, copper. Mining companies can't just flip a switch and say, we want more silver. The supply is incredibly inflexible.
Okay, let's put all the pieces together. You have non-negotiable, growing industrial demand on one side. You have a fixed, inflexible supply on the other. When that happens, there's only one thing left that can give, and that's the price. The unavoidable outcome here is a complete, fundamental repricing of silver itself.
And this is likely how it's going to play out in 3 distinct phases. First, that drain on physical inventories we talked about, it's going to accelerate. Second, you're going to see a major dislocation between the paper price and what it costs to get real physical metal. And finally, after all that chaos, a new, much higher price floor is going to be established.
And once the dust settles, the market has to find a new equilibrium. Projections show that this new floor, the new launchpad for whatever comes next, is expected to form right around $70 an ounce. And let's be crystal clear, $70 isn't the end goal. That's the new foundation. From that new base, the next logical price targets for 2026 start to come into view: $85, and then the big one, $100 an ounce. That's the kind of price it might take to finally force this market back into some kind of balance. So we'll leave you with this final, critical thought. The Shanghai signal isn't just a blip on a trading screen. It's a warning shot fired across the bow of the entire global economy. And it forces us all to ask a very simple but very serious question. What happens when an absolutely essential industrial metal simply becomes unobtainable?